It's 7 a.m., you've got your coffee, you're checking the pre-market movers, and you're looking for the next big structural shift. Usually, we're talking about interest rates, AI chips, or geopolitical flare-ups. But today, the most disruptive force in the global economy isn't coming from a central bank or a Silicon Valley server farm, it's coming from a half-inch needle. We're talking about the $12 trillion hunger strike. And if you think this is just a story about people fitting into smaller jeans, you're missing the biggest economic rewiring of our lifetime. Let's break this down. Here is the number that should stop you in your tracks. 31,000. That is the number of active GLP-1 users in the United States alone. To put that in perspective, that's more than the entire population of Australia. In just 3 years, we've seen a 416% explosion in usage. This isn't a trend, it's a migration. We are watching a significant chunk of the consumer base opt out of the traditional calorie-driven economy. And the ripples? They're turning into tsunamis. When Walmart's CEO John Furner went on the record saying they're seeing a slight pullback in the food basket size of GLP-1 users, the markets didn't just notice, they winced. That slight pullback is the first crack in a $12 trillion global food chain. Think about that. For decades, the entire retail world was built on a simple, predictable biological constant. Humans are hungry, and we like salt, sugar, and fat. But what happens when that constant vanishes? What happens to the world's largest food retailers when their most profitable customers suddenly lose interest in the impulse buy aisle? We're not just talking about a few fewer bags of chips. We're talking about a fundamental shift in how capital flows through the veins of the modern world. Let that sink in. The miracle drug everyone's talking about is actually the economy's first demand-side prohibition. And this time, it's not the law that's saying no, it's our brains. Okay, let's talk about the real problem. Why is this so fatal for big food? It's all in the math. The average GLP-1 user isn't just eating a little less. They are seeing a 25 to 30% drop in their daily caloric intake. That translates to a 9% total drop in household grocery expenditure. Now, you might think 9%? That's a rounding error for a giant like Kroger or Walmart, but here's the deal. Grocery stores and snack manufacturers operate on razor-thin margins. We're talking 2%, maybe 3% net. When you strip away 9% of the top-line revenue, specifically the high-margin stuff like sodas and ultra-processed snacks, the bottom line doesn't just shrink, it evaporates. It's what I call biological prohibition. These drugs don't just make you feel full, they kill the food noise, that nagging voice in the back of your head that tells you to grab a Snickers at the checkout line or a 12-pack of soda because it's on sale. Gone. And when that voice goes silent, the 11.5% year-over-year collapse in soda and snack sales we're starting to see becomes the new normal. Retailers have spent billions on eye-tracking software and shelf-placement psychology to trigger our dopamine loops. But GLP-1s, they just bypass the loop entirely. The dopamine isn't firing for the donut anymore. Now, this is the part I find wild. This isn't just about volume, it's about leverage. The entire food industry is built on positive operating leverage. You need high volume to cover the massive fixed costs of factories, shipping fleets, and cold storage. When volume drops by 10%, your costs don't drop by 10%. Your margins get squeezed in a vice. That's why we're seeing a massive institutional rotation. Investors are pulling out of big food and looking for metabolic tech. The S&P 500 weighting for consumer staples has already dropped by over 22% in the last 3 years. The smart money is betting that the snack aisle is the new tobacco aisle. It's a structural demolition of the status quo. If you're holding these stocks for the dividends, you need to ask yourself, where is that cash going to come from if the world stops snacking? So here's where the story takes a turn. If we're spending less on calories, where is that money going? Because trust me, it's not just sitting in savings accounts. Capital is like water. It always finds a new channel. And right now, it's flowing into what I call the quality of life sectors. Let's look at the sky. Aviation. This blew me away when I first saw the data. United Airlines is projected to save $80 million in fuel costs annually for every 10-pound reduction in the average passenger's weight. Across the big four U.S. airlines, we're looking at a $580 million a year windfall just from the lighter passenger effect. Suddenly, the most volatile variable cost in aviation jet fuel is being hedged by a weight loss drug. That is a fascinating redistribution of wealth. And it's not just airlines. Look at athleisure and precision nutrition. We're seeing a $230 billion surge in R&D investment for metabolic tech. Even the giants are trying to pivot before they get left behind. Look at Nestlé. They didn't just sit there and watch their market share slide. They launched Vital Pursuit, a brand specifically designed for GLP-1 patients. They're trying to trade a $4 box of high-carb pasta for a $10 nutrient-dense companion meal. It's a desperate, brilliant attempt to capture the new body economy. People are trading their grocery budgets for Lululemon leggings and gym memberships. The money is moving from the stomach to the spreadsheet. But honestly, this is the most interesting part of the whole story. This migration of capital is creating winners in places you wouldn't expect. Precision health, longevity tech, even luxury travel sectors that cater to people who suddenly have more energy and more disposable income because they aren't spending $200 a month on takeout and alcohol. Speaking of which, alcohol consumption frequency is down 50% among users. The dopamine suppression that kills the craving for a burger is doing the same thing for that second glass of wine. We are looking at a total recalibration of the vice economy. If you're an investor, you have to follow the dopamine. And right now, the dopamine is moving away from consumption and toward optimization. Let's zoom out for a second and put this into a historical context. A lot of analysts are comparing this to the 1920s prohibition in the US, and on the surface, the similarity is high, about 85% if you look at the disruption to the food and beverage industry. But there is one massive, terrifying difference. Prohibition failed because the government tried to block the supply. People still wanted to drink, so they found a way. GLP-1 is succeeding because it is killing the demand. You can pass a law to repeal prohibition, but you cannot pass a law to make someone hungry if their brain says they're full. This is a one-way street. And this is the part nobody's talking about, your retirement. For decades, consumer staples were the bedrock of every pension fund and 401k. They were the dividend aristocrats, companies like Pepsi, Coke, and Kraft Heinz. They were recession-proof because everyone has to eat, right? Well, that bedrock is cracking. These stocks make up about 5.8% of the S&P 500, but their influence on the stability of safe portfolios is massive. If these companies lose their growth engine and are forced to cut dividends to cover their shrinking margins, the systemic erosion of pension fund stability becomes a real risk. We're talking about the devaluing of the very assets that are supposed to fund your golden years. I know, it sounds dramatic, but look at the data. We've seen a 22.6% drop in the weighting of these safe stocks. The health miracle we all prayed for is finally here, but it's coming with a bill. The math stops working for the traditional retirement model when the companies that provided the steady, boring growth suddenly face a lost decade. So, here's the provocative question for you. If the world's largest pension funds are quietly rotating out of big food, what does that tell you about where your safe money should be? Are we looking at a $1 trillion productivity boom? Or is your 401k being sacrificed on the altar of public health? It's a fascinating high-stakes trade-off. So what is the final map of this new world? In the bull case, championed by people like Jan Hatzius at Goldman Sachs, this is a massive win. A healthier, more active workforce could add a staggering $1 trillion to the US GDP. We're talking about less absenteeism, higher productivity, and a longer working life. In this version of the future, the gains in the tech and service sectors more than offset the pain in retail. It's a leaner, faster, more efficient version of capitalism. But then there's the bear case. Barclays analysts are warning of a lost decade for consumer staples. And don't forget the hidden costs, like insurance. We're already seeing insurance premiums hike by 30% as health plans struggle to cover the $1,000 a month cost of these drugs for millions of people. Your grocery bill might be lower, but your insurance premium is coming for the difference. Here's what you need to keep your eye on. The 2026 health plan renewals. That's when the insurance tax for this health miracle is going to hit the average worker's paycheck. We are entering a period where the definition of a safe investment is being rewritten in real time. The health miracle is changing the very structure of our economy. It's moving us from a world of more to a world of better. That sounds great on a postcard, but for a financial system built on the more calories, more volume, more consumption, it's a radical, painful transition. Bottom line? The hunger strike is just beginning. Whether you're an investor, a business owner, or just someone planning for retirement, you can't afford to ignore the biology. We've spent a century building an economy that feeds our appetites. Now we have to learn how to build an economy that survives our lack of them. Think about that next time you walk past a grocery store. The shelves might be full, but the economy is starting to feel very, very light. I'll leave you with that. The miracle is here. Just make sure you can afford the bill. I'm out. See you in the next one.